Are we live?
We're live.
We're live, guys. What's going on? It is Wednesday. Time for another Wednesday workshop. I'm your host, Nate Hare with NuView Trust Company. And today we have actually one of my favorite topics, Roth Conversions. I'll tell you what, if you guys ever need a real fire starter at a party, just invite me. I can talk about Roth Conversions all day long. So it's kind of one of the nerdy things that we've got going on here, but it's actually a very, very powerful topic. Very, very powerful tool if used right. And we're going to talk about what a Roth conversion is, what are the considerations one would want to make prior to doing a conversion, and show you how it plays out with actual self-directed investments. And I've got 2 case studies about how clients did conversions 2 different ways. And we'll actually have some learning lessons in there as we look at those. So lots of really good content. I'm really excited about presenting this for you guys. If you have questions, go ahead and type them into either the chat box if you're logged into Zoom. I got one of my IRA specialists, Alex, here. He'll answer them as we go along. If there's questions that are unanswered, we'll tackle them at the end. And if you are watching on Facebook, go ahead and just type any comments or questions into the comment section there, and we'll get those answered appropriately. So let's just jump right into it. We're going to talk all about Roth conversions, but first, for anybody who is new to the program, just a reminder about who NuView Trust Company is. We are a self-directed IRA company based in Orlando. We actually run our custodial services out of South Dakota, but our administration office is here in Longwood, Florida, just north of Orlando. We service clients all over the country, though. So we have 11,000 clients. They're scattered all across the United States. And what we do that's different than your traditional custodians is we hold alternative assets instead of traditional assets. So we don't sell investments to our clients. However, we're not licensed securities agents, but we do provide clients more freedom of choice when it comes to their retirement assets by giving them the ability to hold alternative assets such as real estate, promissory notes secured by real estate, investments into oil and gas, private companies, startup companies, private equity, cryptocurrency, the list goes on and on. So I'll talk a little bit about how we do that in what's called a self-directed IRA, but that's just our disclaimer to people out there that even though we're talking about taxation here with Roth conversions, we are not CPAs. We're not giving you tax advice. We're just giving you great education so that you can make wise decisions for yourself when it comes to your retirement assets. So got that out of the way. Let's talk about what a self-directed IRA is now for those of you who are new. A self-directed IRA, when we're talking about self-directed IRAs, don't get confused with that term self-directed. It's just a marketing term. IRAs are IRAs are IRAs. An IRA at Fidelity or Charles Schwab is no different legally than an IRA at NuView. The only reason we call it self-directed is that, as I mentioned before, we don't sell investments to our clients. So the client's decisions for making their investments is all on them. So a self-directed IRA is good for people who know what they want to invest in, and it's an investment that's outside of the stock market. But truthfully, most of our clients have IRAs here at NuView. They also have IRAs at Fidelity because that allows them to diversify their retirement portfolio and hold some assets and some alternative assets by using IRAs at multiple custodians. So that's one of the benefits to self-direction. That's one of the reasons you would have a self-directed IRA with a company like NuView. Again, it's just an IRA, but you're allowed to hold different investment or asset classes in an IRA with NuView that you wouldn't be able to hold at Fidelity or Charles Schwab. So gives you more diversification when you're looking to buy different things. Obviously, IRAs give you special tax treatment when it comes to buying and selling your investments. At a bare minimum, an IRA, whether it's a traditional IRA, a Roth IRA, SEP IRA, simple IRA, blah, 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 all of them grow completely tax deferred, meaning you can buy and sell real estate, buy and sell notes. As long as you do it within an IRA, you pay no capital gains tax on the investments. But what is taxed, depending on the type of IRA you have, is your distributions. So that's point that I want to make today because we're talking about Roth conversions and how we can plan out a conversion and not only buy and sell investments in an IRA tax deferred, but when we take distributions, those are also tax-free and penalty-free. So bare minimum, IRAs give us better tax treatments than us as individuals, but we're going to dive deeper into that today. But when you're investing, you just want to invest in what you know best, right? If you understand the stock market, more power to you, invest your retirement in the stock market. But if you understand real estate, or if you understand note investing, or if you understand cryptocurrency, then just understand you can use your IRA to invest in the things that you understand. You might just have to have an IRA with a company like NuView that will allow you to put those types of investments in your IRA. So always, always, always invest in what you know best, and you will do yourself better in the long term. What are the investment choices that we commonly see? I'll just breeze right through these. Clients, you understand this, you're already doing this. But for people who are not familiar, what are some of the investments we see our clients make in their self-directed IRAs? A lot of real estate related investments, rental property, and how they find those rental properties can be all different sorts of ways. They might find pre-foreclosures. They might buy tax liens or tax certificates. They might pool IRAs together and buy apartment buildings, or do something creative like a real estate option, or invest in condos or land. Again, these are all available options as an investment. You just have to use a self-directed IRA at a company like NuView, where we'll hold those investments, but you have to find the investment. So when we're talking about this asset class, though, this is why the Roth conversion topic is very important to talk about, because it can be analyzed a lot differently, or you can think about your conversion opportunities differently when you have assets like real estate versus just a stock. And we'll get into that deeper as we go along. So just remember that you have all sorts of choices when it comes to your investment options, but it goes outside of real estate. We have a lot of clients that like to use their IRAs passively and invest in promissory notes, whether they're creating promissory notes, doing loans from their IRA to a real estate investor and having that money secured by the property. That's a very common investment we see. Or we have clients that actually buy existing notes, existing performing notes, existing non-performing notes. Again, you're not limited as to your choices. We're just giving you an example of what clients like to invest in. And we have other clients that like to be passive by investing through other entities that might hold real estate or might own businesses or whatnot. So you can invest your self-directed IRAs into trusts. The trusts could be doing all sorts of things. Trusts often own real estate within them as well. You can use your IRA to do a joint venture where your IRA is a capital partner and maybe somebody else is a sweat equity partner. I'm just kind of touching on this stuff. It's not the topic for today. But there's a lot of different ways clients can take their self-directed accounts and invest in alternative assets. The plans that you can use to invest in those assets that I just named is more than just the Roth IRA and traditional IRA that you hear so commonly. A lot of people forget that there's other plans that can be self-directed besides these two plans. Now, we're going to dive into these two plans specifically because it's easy to talk about Roth conversions, talking about these two plans. But a Roth conversion opportunity extends outside of just traditional IRAs being converted to Roths, but can also be put out to these accounts too. You can also convert SEP IRAs to Roths. You can convert simple IRAs to Roths. And if you have a solo QRP or a 401k, you can do, if the plan documents do in-plan conversions of your pre-tax money in a 401k to after money if the opportunity fits your needs. We'll talk about that in a sec. But I just want to remind people that it's not just traditional IRA to Roth IRA. When we talk about conversions, any of these plans, if you've got pre-tax money in there, can also be converted to a Roth. As far as other plans go, we do have other plans here, health savings accounts and education savings accounts. These can't be converted, but still good plans nonetheless. These are also plans that can be self-directed, and we've got some special classes that go over how those plans work. So let's talk about money. Let's talk about the different types of money when you talk about retirement accounts. And we're going to break it down real simply and talk about pre-tax versus after-tax. And really, when you're going over this information, you want to think to yourself, what type of investor am I? And does it make sense for me to have a pre-tax IRA or an after-tax IRA? Most people have pre-tax IRAs. And what pre-tax means is just a big bucket of money you haven't paid taxes on yet. Most commonly where we see that is if you've worked at a job for X amount of years, your company gave you options to make contributions to a 401k, and maybe that company was matching. You might have been a teacher or had a 403b or a teacher retirement savings plan, TRS or TSP. These plans most of the time are pre-tax, meaning when you put money in, if you're putting it in pre-tax, you're getting a tax deduction for the money you put in. And if your employer is matching 100%, they're writing that off of their income. They're putting it in pre-tax as well. So the good thing about pre-tax is you could still invest and buy things free of capital gains tax. But remember with pre-tax is that it's a bucket that hasn't been taxed yet. As you continue to grow it, essentially you are increasing your tax liability. You just don't see it until you start taking distributions. So a lot of people don't even think about converting to a Roth because they just don't see the effects. Okay? This is why this is important to look at, because you want to think to yourself, if I've got a bucket of money this big and I'm going to make it into a larger bucket, does it make more sense to pay taxes while it's small versus paying taxes when it's larger? So that's what we're talking about when we're talking about pre-tax versus after-tax. The after-tax account is the Roth IRA, where any money in a Roth IRA, taxes have already been paid. The trade-off to having money in a Roth IRA is because it's after tax, there's some sweet trade-offs with a Roth IRA that we'll dive into here in a second. But again, different strategies fit different needs. I'm not saying the Roth IRA is better than the traditional IRAs. It just depends on which one is better for you. And a lot of times this comes down to what is your investment strategy. That's going to make more sense whether you want to use a traditional or a Roth IRA. So let's talk about just the benefits of having a Roth IRA before we talk about whether or not you want to convert to one. So the benefits of a Roth IRA, it works the polar opposite than a traditional IRA. Remember, a traditional IRA, you put money in, you typically get a tax deduction. It doesn't make the tax go away. It just defers the tax to the future until you take it. So with a Roth IRA, it's different. Roth IRAs, you make contributions to a Roth. Those contributions are after tax. You've already paid your Uncle Sam your money. Just think about it. It's the money in your back pocket. You make a contribution to a Roth. You don't get a tax deduction. The trade-off, however, though, is sweet, in my opinion. As you buy and sell things in a Roth IRA, you don't pay any capital gains tax, so you can exponentially increase the value of your account by eliminating Uncle Sam out of the equation, at least as you buy and sell things. But when you get to a point to where you've met criteria to have what's called qualified distributions, this is where the real magic happens. Qualified distributions from a Roth IRA is when you've met two criteria. One is having a Roth IRA open for 5 tax years. Okay, now this timeline is based on the first tax year you make a contribution to a Roth. So let's say you made a contribution today. Okay, we're in 2021. The start date for your Roth IRA would begin actually January 1st, 2021. So you have to meet a 5-year seasoning requirement, and that's qualifying criteria 1 to have qualified distributions. Along with that 5-year seasoning, you have to be either above the age of 59 and a half, die, or be disabled. Okay. 1A is better than B and C. So let's just talk about having a Roth IRA open for 5 tax years and being above the age of 59 and a half. Once you have those 2 criteria met, you have now what's called qualified distributions. And qualified distributions from a Roth IRA are tax-free and penalty-free forever, meaning you can live tax-free off of the distributions from your Roth IRA and never have to pay Uncle Sam a dime again. So if you think about that in retirement, when we put in the play of real estate as an investment, right? Real estate investments, the cool thing about real estate investments is they're tangible. Okay? We have a lot of clients that like to accumulate rental property in an IRA, but even better in a Roth IRA. And let's just say you get to a point to where you have a Roth IRA that owns, 10, 12 properties. I see it all day long. Okay? 10, 12 rental properties owned in a Roth IRA, and now you're 59 and a half and you've had the Roth open for 5 years. Those assets don't go away. You don't have to sell those assets to live off any of the income. Whereas if you own stocks, you got to sell stocks to live off any of the income. Since real estate is an income producing asset, you can just leave those properties in a Roth IRA, have tenants pay your Roth IRA rent every month, and you get to live tax-free, take tax-free, penalty-free distributions of those rents till the day you die. Okay, you've already paid Uncle Sam. It's a great way to retire if you can accumulate assets that are income producing like that. Same goes for notes. Okay, we have a lot of note investors that will own notes and own them in a Roth IRA. And once they hit that age of 59 and a half and they've had the Roth open for 5 years, well, every time one of their borrowers pays interest to their Roth IRA, they can just take it out to themselves, tax-free and penalty-free for the rest of their life. Okay. I also see clients do something like this. Let's say that you want to retire in Florida. Florida is a great place to retire. I've actually had some clients that don't live in Florida, but they plan to move to Florida in retirement. What they do is they actually will use their IRA, specifically Roth IRA. They'll buy a condo in Florida and rent it out. For many years, the Roth IRA collects the rental income on that condo. And then when it gets to retirement age, they're above 59 and a half and they have it for 5 years. If they ever want to use that property or live in it, well, they can't do it when it's in the IRA because that would be prohibited, but there's nothing stopping them from taking a distribution of that asset to themselves. And how much tax would they have to pay to take a distribution? If it's qualified distributions, zero tax. So it doesn't matter how high the property appreciates in value. So again, that's a strategy I've seen some people use when they know they want to retire in, say, this city, and they buy something ahead of time and take it out tax-free, penalty-free once they have qualified distributions out of their Roth. The other cool thing with a Roth IRA, since you've already paid Uncle Sam, there's no required minimum distributions. Required minimum distributions are only on traditional IRAs if we're talking about the account owner, the original account owner. If you have assets in a traditional IRA, once you hit age 72, because that's pre-tax, IRS says, hey, remember all those tax deductions you took for that money that you've got in there? Yeah, you owe us 30% of that or whatever it is, your tax bracket. You need to start taking distributions now because we need to get our share. So at 72, they force you to take required minimum distributions each year. When you're forced to take money out, and let's say your accounts are illiquid, what does that force people to do? Well, they end up having to sell property just to take RMDs. Well, sometimes you don't even need to take RMDs, but if you have a traditional IRA, you're forced to take RMDs. So that could be a tricky situation if you hold assets like real estate, right? It's so easy to sell real estate as it is to sell stock. So with a Roth IRA, RMDs are out the door. You don't even have to worry about it. So it does allow you to preserve more of your wealth because you're not forced to distribute it. And then the other thing is looking past your own life. How do you want your assets to live on when you are not around? Okay? When you have assets or you have any type of cash or things in your traditional IRA, well, when you die and that passes to your heirs, that becomes their tax liability. So you might have planned to live off of this income in a lower tax bracket in retirement, but if everything is held in a traditional pre-tax account, when you die, it'll turn into an inherited traditional IRA, and that's good to pass that stuff on. But with any inherited account, your beneficiaries are forced to take RMDs each year for at least 10 years. But if it's traditional pre-tax money, they have to take distributions and it's taxable to them. So oftentimes what happened is you might have been in a lower tax bracket because you're retired, but when you die and you pass that on, well, now the people taking the distributions are in their working years, most likely. They're just adding more income to their already existing income through their job, and they end up paying more in taxes than, say, you would have in retirement had you been using that money. So how do you want to pass on generational wealth? Think about that for a second and think about maybe that's the reason you convert your traditional IRAs to Roth IRAs, because when you pass an inherited Roth IRA on, even though there's still required minimum distributions to the person that inherits it, the distributions are tax-free and penalty-free forever. So again, what kind of legacy do you want to leave for your next generation? That obviously plays into this situation as well. Moving on, let's talk about how a conversion affects you. Okay, let's talk about we'll talk about that, and then we'll talk about the considerations you want to make. So real basic, how a conversion affects you is when you take money from a pre-tax account to an after-tax account, SEP to a Roth, traditional to a Roth, simple to a Roth. What happens is when you do that conversion, you fill out a conversion form, the date of that distribution is the year you have to pay the taxes for that distribution. So if I did a conversion today, that distribution is effective as of today's date, which makes it 2021. So how does that affect me personally? it's going to be added or included in my modified adjusted gross income. Okay, I don't have to pay taxes on it today. I just have to add it to my income, and I have to pay taxes on my income plus my conversions when it comes to tax time the following April. Okay, so if you do a conversion today, it's added to your modified adjusted gross income, and you pay taxes when it comes to your tax filing deadline. So could timing play an effect? Sure. Earlier in the year, you have more time to plan for the taxation. But again, if you do a conversion today, taxes are not due today. They're due in April. You won't even see the 1099 that is generated from the conversion until the following January. Can you do multiple conversions? Yes. Multiple conversions, let's say you did multiple conversions with NuView. You could do 3 different conversions through the year. It's still going to be totaled on one 1099 coming next January. So again, you can plan that out, but it's just treated as income to you. The reason I say that, a lot of clients get confused because they think, well, if I convert $100,000 from my traditional to my Roth, does that mean $70,000 is going to my Roth? No, we don't hold back money for taxes. The entire amount is moved over. You just are agreeing to pay the taxes on it, and that's reported on a 1099. And there's no penalties for doing conversions. So even if you do this prior to 59.5, you don't have to pay penalties. You just have to pay taxes because you're moving it from a pre-taxed account to an after-tax account. Things you might want to consider. Since it's added or included in your modified adjusted gross income, where does that put you as far as a marginal income tax bracket as an individual? Because remember how we're treated, we have marginal income tax brackets. You can look at this, and again, this is some planning that you might want to do with your CPA. Obviously, a lot of people don't know what they're actually going to make by the end of the year, but you want to look at that ahead of time and see, okay, if I convert this much money, is this going to put me in a higher tax bracket? A lot of times you got to make some assumptions, but make some educated guesses there. But you can plan out accordingly how much you think you'd want to convert and what tax bracket you want to stay within. Obviously, when you think about that, maybe lower income years is a better time to do a conversion. With COVID, it put a lot of people in a position to where conversions might have made more sense because a lot of people were in lower income years. You might have lost your job, you might have been furloughed. So again, look for opportunities like that, and you just look at your overall life. Do you think that you're going to make more money in the future or less money in the future? That obviously plays in to considering doing a Roth conversion, but it really just depends. Just hold that thought, because I'll go over some other considerations that I think, in my opinion, outweigh what income tax bracket it puts you in. Another thing that you want to consider is that when I mentioned the 5-year clock on Roth IRAs, there's actually 2 5-year clocks. The first 5-year clock, which I talked about on the previous slide, that starts from the date of the tax year of first contribution. Okay, so that's the year for your initial Roth IRA to have tax-free, penalty-free distributions. When you do conversions start their own 5-year clock. Okay, that could get a little confusing if you're doing a lot of different conversions. I actually know some clients that will do conversions. They'll open a separate Roth IRA just so that they can track when their money is going to be tax-free and penalty-free to them. But how that works is the conversions have to be seasoned for 5 years before you can take the earnings off of that conversion out penalty-free. Okay, so not to get too confusing on everybody, but just remember, conversions start their own 5-year clock, and it's specifically based on the earnings in most cases. But just keep that in mind, because again, if you're looking to create tax-free, penalty-free distributions in the future, sometimes waiting is just going to kick that can down the street and just delay your 5-year clock from taking out earnings tax-free and penalty-free. Moving right along, let's talk about some other considerations, and then I'll get into some case studies. Questions you want to ask yourself: what are your assumptions about tax rates and laws generally in the future? Nobody has a crystal ball, but you probably understand your situation better than anybody else. What I often hear people say, and I just don't think it's true in most cases for most people, is they think, well, if I'm in my working years, I'm paying higher taxes than when in my non-working years in retirement. Well, that might be true to a certain degree, but how frugal are you looking to live in retirement? Are you trying to live in an income bracket that puts you at 15%? I don't know if that's the type of retirement that I want to live. I still want to have some income generated, and I don't mind being in a higher tax bracket because I want to live in retirement, not just live frugally in retirement. But again, everybody's different. So, but what are your assumptions about tax rate? Now, most people would argue taxes are relatively low compared to history, and they think that taxes are going to go up. So that's something that you want to think about as to whether or not you do a conversion. What are my taxes now? What are they going to be tomorrow, do I think? Do you expect to be in a lower or higher tax bracket when you retire? Kind of mentioned that. That's kind of included. Can I afford to pay the taxes from funds outside of your IRA? So this is an important one. And this is where it comes in key, where sometimes early in the year, doing conversions there gets you more time to prepare for the taxes that you would pay on a conversion. But it's oftentimes better to pay those taxes out of your own pocket. Because remember, this is just treated as income to you. Okay? You're going to pay normal income tax on it, and you're going to pay the taxes like you would normally pay taxes. Some people, and we'll talk more about this in the case study, some people will do a conversion from a traditional to a Roth, do an investment, and maybe the investment pays off really well, and then take some of the profit out of that investment and pay the taxes. It's not the best way to do it because you're going to add a penalty to the distribution. The best way to do it is actually to pay for the taxes outside of your pocket. So again, timing might play a part. If you do it in January, it's going to be a lot easier to plan for those taxations compared to whether you did it in December, where you have 4 months to figure out how you're going to pay those taxes. Another real important consideration is what's your recovery period? When will the tax-free growth in your Roth IRA surpass the amount of taxes it took you to convert? This really comes down to the investment. And this is really, when we talk about this in real estate or alternative assets, where you're in more control of the investment. If you're experienced in the field, you kind of have a good idea as how much you can make on this flip in this neighborhood, yada, yada, yada. This is probably one of the more important considerations outside of just what am I going to pay in taxes. If you can convert and say pay 30% on the taxes on the conversion, but the investment that you make is going to make 30% in 3 years, well, that's your recovery period. So you got to ask yourself the question, is that fine for me? If I have that, the taxes paid through the tax-free growth in 3 years, everything beyond that point is ching, 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 ching. So that's going to be all tax-free and penalty-free. But if you have an investment like a CD, well, a certificate of depression, we know how low the returns are on that. It's less than 1%. So would I ever just think about doing a conversion and pay 30% in taxes to move a traditional IRA to a Roth IRA to get less than 1% return on a CD? No, it doesn't make sense. But it's not that the conversion doesn't make sense. It's the investment doesn't make sense. So you got to weigh out your recovery period. How much time is it going to take me to see the tax-free growth equal and surpass the taxes I paid to convert? And I always got to remind people, you're going to pay taxes either way. Okay. If you don't convert, you're just delaying the tax burden to the future. You just don't see it until you start taking distributions. So again, how big's your bucket now? How big do you want to make it? And what's the recovery period on the taxes to rip the Band-Aid off now versus paying taxes on the entire bucket down the road? Other considerations, again, like we mentioned this, will the conversion put you in a higher tax bracket? Will that affect any deduction credits? You got to add in Social Security tax, Medicare tax. Again, these are taxes that you would have to pay on any distribution, but you're really just trying to decide whether or not it makes sense to rip the Band-Aid off now or just delay the taxes to the future. Here's another thing that I want to point out too, is that you can do partial conversions. You don't have to convert your entire traditional IRA to a Roth IRA. So if you've got $500,000 in a traditional, but the investment you're looking to do is just do a $100,000 note, but you think it's going to be very, very profitable, and you want to convert prior to doing the note, you just need to convert enough to do the note. You could convert $100,000 out of your traditional IRA and convert that to a Roth IRA, and then have the Roth IRA be the lender on the note. You don't need to convert the entire bucket. So one thing when it comes to strategy is, if you think the investment you're going to make is profitable, then you might think about just converting enough to do the investment, okay? And maybe you do that on each investment as investments come down the pipe, and you spread the taxation on your conversions over several years because you're doing it prior to each investment, not trying to just convert a bunch of money just to convert. And then we kind of mentioned this. Do you want to leave the payment of taxes to your beneficiaries, or are you willing to pay the taxes now so your beneficiaries receive tax-free income in a beneficial Roth? A beneficial Roth IRA is one of the greatest gifts you can ever give to anybody. It is a tax-free bucket that they can still continue to invest. Your beneficiaries can invest, but the distributions are tax-free and penalty-free for at least another 10 years in most cases to your heirs. So preserving wealth, passing it on tax-free is definitely probably the way to go, depending on your assets. And here's the biggest consideration. What are your projected gains on the investment? I think this outweighs every other decision. Obviously, the other considerations, how much is it going to cost me? What tax bracket is that going to put me in? How much time do I have to recoup the taxes? What's my recovery period? Those are all important. But don't focus too much on that if you've got an investment that's very profitable and you decide, well, I don't want to be in a higher tax bracket, so I'm just going to do this investment in my traditional IRA. You're probably creating yourself more taxes by just delaying that Roth conversion than had you just ripped the Band-Aid off. So I've got a case study that shows how a client just did one investment, one flip, took him 8 months, and his recovery period was met as soon as he sold the investment. So when you see it through a case study, it makes a lot more sense. All right, moving on. So I often get this question. Well, Nate, I thought I made too much money to have a Roth. There are circumstances where if you make a healthy six-figure income, you cannot make contributions to a Roth. But conversions do not have any income limits associated with them. This was removed in 2010. Okay, in 2010, there was an income limit on Roth conversions. Prior to 2010, if you made $100,000 or more, they said you could not convert. You just couldn't do it. Today, there's still income limits on making contributions as well. Okay, so oftentimes it gets confused. People think, oh, then my CPA told me I make too much money to have a Roth IRA. Well, that's partly true. You can't make a contribution to a Roth IRA if your income exceeds the income limit, but that doesn't mean that you can't convert to a Roth IRA. And I'll show you actually how that's done with a lot of our clients that like the Roth IRA, but make too much money to contribute. Okay. And this is called a backdoor Roth IRA. So if you really, really, really want a Roth IRA, but you exceed the income limits, how do you have a Roth IRA and how do you get around those rules? So based on the new rules, based on the fact that there's no income limits to convert, here's how someone would have a Roth IRA if you're above the income limits. First, contributions to a traditional Roth IRA are the same. So we're talking just contributions now. Okay. If I'm going to make a contribution to a traditional or a Roth, okay, the contribution limit is $6,000 per year. And that's under the age of 50. If you're above the age of 50, you can throw $7,000 in. Okay. Now that's in total. These are personal plans. So you can't do 7 in a Roth and 7 in a traditional. It's 7 combined. Okay. But if you are above the income limits, what do you do? So the Roth IRA contribution limits, there are phase out ranges, I'll tell you, but if you're a single filer, okay, it's just you on your tax return. If your modified adjusted gross income is above $140,000, you can't make a contribution to a Roth. If you are married and you're filing jointly and your adjusted gross income is above $208,000, you can't make a contribution to a Roth. So how do you do it? You make a contribution to a traditional because there's no income limits to make contributions to traditionals. And ever since 2010, there's no more income limit to do a conversion from a traditional to a Roth. So we just call it the two-step. You just do the IRA two-step, make a contribution to a traditional and immediately convert it to a Roth. The IRS is perfectly aware of this, right? It's even named the backdoor Roth, okay? One thing I will tell you, this is not a doomsday scenario. Don't assume that that income limit will be off forever. The reason they took that off, it actually started back in 2005, I believe, is when they started introducing this idea of removing the income limit off conversions. But my assumption is, well, what was happening in 2007, 2008? We were going through a massive recession, mortgage crisis, okay? The IRS is a company that's in the business to make money. Well, when you're in a crisis, it's kind of hard to get people to pay taxes when people are losing their jobs and so forth. So what's one thing that they did to incentivize people to encourage them to pay taxes? Let's remove the income limit off conversions. Let's allow anybody, regardless of their income, to pay taxes on their pre-tax accounts and move it over to their Roth IRAs. So in 2010, they released this, and you saw millions and millions of people converting because it was their first opportunity to have a Roth IRA. They were six-figure income earners. They couldn't make contributions. They couldn't convert. Now, 2010, the doors fly open. They actually even gave them more incentive and said, if you do a conversion in 2010, you can pay half the taxes in 2010 and half the taxes in 2011. So you saw so many people moving to Roth IRAs because it was the first time that they had the ability to do that. That income limit's been off ever since. Don't take for granted that they might put that income limit back on depending on where the economy's at. No one has a crystal ball. I'm not saying that they're going to do it. You just never know. So the reason I say that is take advantage of the rules as they appear today. Don't rely on them to be the same, say 5 years from now. But that's the way to get money in a Roth IRA, regardless of your income, is through conversion. So it's just important that we bring that topic up. Another thing I want to mention, this also applies for SEP IRAs too. Now, the reason why the SEP IRA is so attractive in this scenario is that first, you have to be self-employed to have a SEP IRA. But if your income justifies it, you can make contributions up to $58,000 to a SEP IRA. Okay? The SEP IRA is just like a traditional IRA, but however, you can put larger contributions into a SEP IRA. So here's what a lot of our client-savvy self-employed investors do. They'll make a contribution to a traditional, but they'll also try to max out the contribution to their SEP, and then they'll convert both of those over to their Roth IRA. Again, there's no distinction as to what accounts you convert from. So a SEP IRA is a pre-tax account just like a traditional, but you can convert larger amounts if your income qualifies for it. You could also do it with a simple. Be cautious of the simple IRA, though. If you are just setting up a simple IRA, it's funny that they call it the simple IRA because it's the most complicated out of all the IRAs. There's a 2-year rule with a simple IRA where you can't convert until you've had it open for 2 years. Again, that doesn't get most people, but if you have a simple IRA that's pre-tax, you've had it for longer than 2 years, then most likely you can convert that as well. So just telling you guys how you can backdoor more money into a Roth IRA if you want to live tax-free in retirement. A reminder, there's no income limits to convert, but there may be income limits to make contributions. There's also no limit on the amount you convert. I get that question a lot too. A conversion, you can convert $1 million if you want to. You just got to realize that you got to pay the taxes come tax time. So just plan it out accordingly. So let's look at some case studies. Let's see where clients actually did conversions and one who didn't do it with conversion and wished he had done a conversion. We're going to look at both of those stories. So let's first look at a guy, actually a gal, that did a conversion prior to the investment. Let me give you the backstory of this person. They're a real estate investor. They had been working in an area of their town where they had flipped 4 properties personally. Okay, 2 years, they were buying property. They had their sign up. People in the neighborhood kind of knew, hey, that's that lady that's been flipping properties, right? And pretty good flipper, to be honest. But she was kind of establishing the market for herself because she was the one taking properties and selling them. So she was kind of establishing the values in that area, you could say. But she was very confident as to what price homes were going for in that area and what rehab costs would cost and all that type of stuff. So here's how she came across this deal. First, she had just moved over her traditional IRA to NuView because she had just left her corporate America job to be full-time real estate a couple of years back. So she rolled over $150,000 from her traditional at Fidelity to her traditional at NuView. In the meantime, she's out doing something with one of the houses that she's just finishing up personally, taking down the sign or whatnot. And the neighbor next door comes out, walks up over and talks to her, approaches her. Says, hey, I've noticed your signs up for the last couple of years. I assume you're a real estate investor. I might need some help. I don't know if you can assist, but I was supposed to sell my house and the buyer fell out of escrow, right? The buyer could not qualify for the loan. Bank took back the loan. So basically he was left between a house that he couldn't sell. But here's the problem is that he needed to move to North Dakota and close on his house in North Dakota. He had a job transfer. He was working oil and gas. He was moving there and he could not close on that house until he sold his house that he lived in now. So, and he had his family to worry about too. So motivated seller. Yeah, this guy was within 2 weeks of having to close on his property in North Dakota, and he just needed somebody to buy his property last minute. So the real estate investor, Jane, said, well, yeah, I think I can help you out. Obviously with the negotiation, since it's a motivated seller and she's coming in and solving a problem, they negotiated a pretty nice deal. Obviously, the guy wasn't getting retail, but why would he at this point? So she knew going into this deal that she was getting the property under market value. She was already walking into a discount. So she immediately started thinking about her IRA and said, well, I got to put something in my IRA. And if I'm walking into a discount, do I want to pay taxes on the discount? And I know what I can sell this property for. Do I want to pay taxes on the gains? So what she decided to do is she decided to convert her traditional IRA to a Roth first because she wanted to buy the property in her Roth IRA. So she did this back in January of 2011. Now I look back at the tax brackets. Let's assume that this puts her in a 33% tax bracket. Okay. Now remember that the taxes due on that conversion are not until April of the following year. So literally she's got about 16 months to plan to pay these taxes. Okay. And if we're assuming that's going to be hit at 33%, that would be $49,500 that she would have to dip out of her pocket and pay come the following April. Okay. So, but she was fine doing that. And this is why. So we did the conversion. Conversions don't cost anything at NuView. All you do is fill out a form. It's converted the next day. She then puts an offer on the property. She draws up the contract to buy it in her new Roth IRA, which the buyer would read NuView Trust Company, FBO, client name, Roth IRA account number. Okay. Not traditional, Roth. The purchase price, rounding it, was $101,000. We paid contractors about $30,000 over the next 8 months, 6 to 8 months. And then she sold the property or had it listed to be sold. Again, the buyer and seller is the Roth IRA. We sign all the documents. She just finds the end buyer. The property was sold for $239,000. Giving her Roth IRA a profit of $94,000, which was 72% rate of return, completely tax-free to her Roth IRA. So what's her break-even point? When did she eclipse with tax-free growth, when did she eclipse the taxes she had to pay? 8 months and then some, right? So the taxes have been paid. The taxes were paid out of the way. And here's the continuing part of this story. She didn't stop there. After this investment, she did one more flip in the Roth IRA before the year ended. She did 2 more the following 2 years. Now her Roth IRA sits valued at above $650,000, but remember, it's tax-free $650,000. So if you look at that, sure, she had to pay 33% taxes to get it converted, but would you rather pay taxes on $150,000 or would you rather pay taxes on $650,000? I think you throw tax bracket out the window at that point because you can see how much she's saving in the long term. Now she's not quite 59 and a half. But when she gets to 59 and a half, and this has been converted for 5 years, which it will be, now she's got a bucket of Roth IRA money that she can step out of the investment game if she's got enough. She doesn't have to do a single investment in her name again, because remember, she's a taxpayer. If she's got this tax-free, penalty-free bucket of Roth money, why would she not just buy every single investment in her Roth IRA and just live tax-free, penalty-free up the distributions? She could continue to flip properties, and there's no RMDs. So she's not forced to liquidate. She can continue to exponentially increase the value of her account by investing in things that she's knowledgeable about and just live tax-free off monthly distributions coming in from the rents or coming in from the profit from when she flips property. It's a great, great way to go. And then when she passes away, her heirs are going to get whatever's in that account, but they're going to get it tax-free in an inherited Roth IRA versus taxable in an inherited traditional IRA. So she did it right. Again, this is a home run, knocked out of the park. But again, it wasn't really that much of a home run. She found a buyer, motivated seller. She knew she was getting a discount. She knew the area like the back of her hand. And a lot of real estate investors out there, I know I'm talking to you guys, you can probably look and know that you've got a really good deal on your hands. And that's something that you can use as a strategy with conversions is if this is a really rock star deal, maybe it makes sense to convert. If it's I don't know how much, how much it's going to make, well, then just maybe keep it in the traditional because you're not sure. Okay. So you can play with it. And again, she did really well for herself. Can you convert assets or do you have to just convert cash? So in her situation, she converted the cash, right? Converted $150,000 over. Converting cash is easy because we know the value of cash. Can you convert assets? yes, you can convert assets. And this is what our next client did. The only difference with converting assets is that you don't know the value of the asset. So if you buy a property in your traditional self-directed account, and you decide, you know what, this investment's going really well. I think that I want to get the taxes out of the way. This is being rented. It's going up in value. I want to pass it to my heirs tax-free. I'd rather convert this and make this a Roth IRA owned property than a traditional IRA owned property. In order to do that, what we have to do is just think about our reporting requirements at NuView. Well, if on the value of any conversion, we're going to have to send a 1099 to old Uncle Sam based on the amount you asked to convert. If it's an asset, if they ever come knocking and say, why'd you send the value at that? We have to have something showing this is why we used that value, or this is why we made the distribution at that amount. So when you have real estate, you just have to get an appraisal. You got to get a hard value. It can't just be a soft value or on a fair market value form. You got to get an actual appraisal. And that's the number that we're going to use. And you can decide to convert based on that appraised value. I will say this without getting too jinky, real estate investors, is find the laziest appraiser in the county. This is not one of those appraisals that you want the highest and most aggressive value. You just give me the value, man. Get the appraiser that never gets you the values on the ones that you're trying to sell personally. Get that appraiser to work on this one. Because again, it's going to be based on your converted amounts can be based on what that value comes back at. So here's the situation with this gentleman. First, he bought a property in his traditional IRA back in 2009. Now, this is a person that retired. He had money in his former employer 401k. Remember, former employer 401ks are usually pre-tax. When that rolls into an IRA, it goes into a traditional pre-tax IRA. So he had rolled it over to NuView, found a property that he wanted to buy in 2009, and the property was awesome. But remember what was going on in 2009, right? Properties were just at a bargain. It was like fire sale. If you had the money to buy property, you were buying it at the lowest and best value. So, and then it shot up from there. So he bought this property in his traditional IRA through NuView, 2009. Okay. Since 2009, the property has more than appreciated. Okay. I'll just tell you the value of this property is well over $600,000. It's a multi-unit property, just to give you some background. Okay. It's a multi-unit property. The value is up in the $700,000 range. Okay. The rents on this property today actually are about almost 30% of the return on investment. Because remember, he bought it at $330,000. That value doesn't change. But when he started renting the property out, and this is multi-unit, he was getting about $5,000 in 2009 a month net. And then that increases over time as rents go up each year. So now today, or a couple of years back when we did this case study, he had $8,000 a year coming in just in the rents alone. So that's 29% return on his money. But remember the account this is in, a traditional IRA. So I had talked to him, and when he was telling me the case study, first of all, I thought the investment was solid. Bought at the right time, bought in the right area. He's got it rented. He's got property managers. He did all that stuff right. And my nerdy brain just decided to ask him, did you ever consider converting this to a Roth? And he said, my CPA told me I made too much money to convert. I said, well, I hope you fired that CPA and you're not using him anymore, because you could have converted this anytime prior to or up to 2010, right? He bought this in 2009. The property was still about the same in 2010. And he was under the assumption he couldn't convert because it would have been putting him in a higher tax bracket. So not true on conversion. So when I told him that, I thought his wife was going to murder him, because she looked at him and was staring a hole through the side of his head. He didn't see it, but I could tell that she had maybe mentioned this to him before. But again, now what are you going to do, right? You've got this asset, it's appreciated X amount, it's got rents coming in, and it's all taxable because he's getting to an age where he's going to have to start taking required minimum distributions. And if there's not enough cash in the account to take the distributions, he doesn't want to be forced to remove this property from his tax advantage, even IRA, traditional IRA, just to take RMDs. So I asked him, I said, well, what's your plan with this investment? You can't go back in time. There's no magic, time machine to go back and do a conversion in the past, but what's your plan? And he said he wanted to leave it to his kids. He wanted to leave it in an IRA and have them live off the income. And I said, well, just food for thought is if you leave it in a traditional IRA, well, they're going to pay the taxes on it. So it's going to be less money that they would get. So here's what he decided to do. He decided to start doing conversions of this asset. Now, unfortunately, he can't convert the entire asset, because remember, it's say worth about $700,000. He doesn't have enough money to pay the taxes to convert $700,000. So what does he do? Each year he gets an appraisal and he does a conversion of a small amount based on what he can afford. Okay. Looks at his tax bracket. What's he in the retirement? How much is this going to add? What tax bracket is that going to put him in? Okay. And then he just does small conversions each year. How does that affect the property? The only thing that's affected on the property is that the ownership percentages change. When he started the investment, it was 100% owned by his traditional IRA. As soon as he starts doing conversions to a traditional IRA, nothing happens really with the asset. It's just now you're putting the Roth IRA in as an owner as you convert more, and the percentage of the Roth IRA increases each time you do a conversion, and the percentage of the traditional IRA decreases as you convert money over. How does that affect NuView? It doesn't really affect us at all. You can still have rents coming in, and he's got rents coming in from his property manager that are just sent to NuView. And we know based on what the ownership percentages of that asset are, we just split the checks pro rata, right? If it's 50-50 owned in his traditional Roth, we're just going to split the income 50-50 between his traditional and his Roth IRA. And his plan is to ultimately have the entire asset converted, but it's going to take him, several years to do that. But again, he can't go back in time and fix, what he didn't do, but going forward doesn't mean that you can't, look at that going forward. And he's well over 60 years old. I know we had a question that came in prior to the show. A great question. Does a conversion make sense if I'm over 60? I've gotten that question a lot. Does a conversion make sense if I'm over 70? Does a conversion make sense if I'm over 80? It just depends. What do you want to do? Okay. And what's the investment? Are you looking to pass more wealth on tax-free? Sometimes that's enough of a decision maker for someone to just convert. Or do you have an investment that's going to be profitable, right? If the investment's going to make 30-40% in a year, say you're doing a flip, then sure, it doesn't matter if you're 70, 80, or 90. You could get rid of the taxes and at least have the gains completely tax-free by paying taxes on the principal and let the gains be tax-free in a Roth. So there's no real I would say situation where you're excluded from having a Roth IRA makes sense. It depends on what you want to do with it, what's your plan in retirement, what's your plan to leave assets on, and then what is the investment. That's the biggest decision or criteria that I think you need to look at. All right. So we're going to wrap it up and we're going to take questions. So I love this topic, guys. I love talking about Roth conversions. There's always a way to look at how do you create more tax-free wealth for yourself. If you are just starting out and you don't have an IRA, but you make six figures, again, look at that backdoor Roth opportunity. If you're self-employed and you have the opportunity to make large contributions to a SEP, look at the opportunity to convert those while the rules are as they are. And just think about how you can utilize this tool that allows you to preserve wealth in retirement because you don't have RMD. So I hope this information was helpful to you guys. And we've got quite a few questions here. Let's see if I can attack them all as we go along. So does seasoning on conversions apply to all ages? Yes, John, thanks for the question. So seasoning on the Roth conversion, remember there's a 5-year seasoning. So this is actually this perfect example. Let's say you're past the age of 60. Let's say you want to do a conversion, but again, you've already met one criteria to have tax-free distributions out of a Roth IRA, which is being above the age of 59 and a half. So if you were to convert, let's say $100,000 from your traditional to your Roth and you're above 60, okay, you're going to pay the taxes at the time you do the conversion. So taxes have been paid on that amount, the principal balance of your conversion, $100,000. You could, the next day, because you're 59 and a half, you could decide to start taking distributions of that amount, that principal amount, tax-free and penalty-free, because you pay the taxes on the conversion, and since you're above the age of 59 and a half, you don't have to pay an early withdrawal penalty. The seasoning, though, is going to affect the growth that you have on top of what's ever above that $100,000. So if you make an investment, you make another $25,000, that could be penalized if you take that out prior to 5 years. Now, most of the times you're not doing that because you're trying to just figure out new investments to have in the Roth so it can continue to grow. But if you were to convert $100,000 and then liquidate everything, the next 2 years, well, you're going to pay some penalties on the earnings. That's just the way that goes. So I always say start early, start right away. There's no reason to wait. If you've got a good investment, convert it, get that 5-year clock ticking. That's how that works. Is there a 5-year seasoning requirement for Roth funds from a Roth 401k transferred into an older Roth IRA, or will funds use the Roth start date? Great question. Roth 401ks have their own 5-year clock as well, and Roth IRAs have their own 5-year clock. So if you have a Roth 401k, it might be advisable for you to start a Roth IRA outside of the 401k, because that has a different time clock than your Roth 401k. Definitely look into that. Decide what you want to do. It depends on what type of 401k you have too. If you've got a solo 401k, a lot of times you don't need an external Roth IRA because you can do in-plan conversions. And that would be the other question is, do you have the opportunity to do in-plan conversions in your 401k? But those have separate 5-year clocks than the actual Roth IRA. Great question. John asked another question. In the example on the flip, why not purchase and rehab in the traditional and then convert at the value of the money spent? Would that not establish value? You could do it that way. It's just, you're going to add a cost of getting an appraisal to do that. So, and obviously with the conversion of 150, and I see where you're going, because they spent 100 to buy it. They rehabbed it for 30. They didn't know what the rehab was going to be. So they just figured, well, I might need all 150 to do this investment. Because let's say they just converted exactly what they thought they needed, $131,000, and then they needed more money to finish the rehab. Well, they can't just pay for the rehab with their traditional IRA because that would be prohibited. They'd have to convert more. So it's just all about what's easier for you to do. Is it easier just to convert it and convert a little extra just in case you need the money? But let's say an example, let's say he had a $500,000 or she had a $500,000 traditional IRA. That's probably a situation where you're not going to convert $500,000, but since she was almost, at 150 anyways, I think that's why she just decided to just do it all at once. And why leave extra money there? It didn't cost her much extra to do that. Let's see, for the above questions, since both accounts are Roth, if I transfer the funds to an older Roth, okay, I see what you're saying. So if you have a Roth IRA, if you've got a Roth IRA and you're rolling money into that Roth IRA from an old employer plan, it's not going to start a new 5-year clock. If you move money from a 401k and you've got some after-tax money in there, that's going to roll into your Roth IRA, but your Roth IRA has a start date of when you started that actual Roth IRA. So it's not going to start a new year clock by just rolling new funds into the Roth. The only thing that will start a new clock in that situation is if you are converting money from a traditional IRA to that Roth IRA. But moving existing Roth funds won't start a new clock for that. Let's see, we have struggled with the decision for so long. You have really simplified the decision factors. Thank you, Nate. I appreciate that. Thank you, Linda, for the kind words. What are those limits? I'm not sure what that's referring to. If you can clarify, Anonymous, what are those limits? I'm not sure what you're referring to. I'll get to that. When the traditional changes bank, does it affect the other IRA, for example, the personal ones, when the traditional changes banks? No. So I think what you're asking is if as you move from different custodians, does that start new clocks or does that change anything? No. So with traditional IRAs, if you move from a traditional IRA from Fidelity to a traditional IRA here, it's still just a traditional IRA. If you're doing it via transfer, it's not even reported to the IRS. It's just moving money from one IRA to another. But I do get this question a lot. If I close out my Roth at traditional and I transfer that to a Roth at NuView, does that start my 5-year clock over? No, it does not. So your Roth IRA start date for your Roth IRA when you make the first tax year contribution is always going to be January 1st in the date in which you made the first contribution. Now, some people have gotten in this situation, and I don't have a clear answer for it, but I will just bring it up. They say, well, I had a Roth IRA like 10 years ago and I closed it out. Can I use that start date? It's undetermined on how long you can go in between having a Roth if you distribute the entire thing and then you want to start new. But if you are just moving Roth money and even closing a Roth IRA out to move it to another Roth IRA, that's not going to start your 5-year clock over again, if that makes sense. David, when leveraging a Roth IRA for mortgage on real estate, how do lenders qualify the borrower? Okay, so we're getting off topic a little bit, but I'll address that question because we have actually some classes coming up that I'm going to talk a lot about that. And what David's referring to is IRAs have the ability to get loans from banks. There's actually banks that have asset-based loans that they will loan to IRAs who are buying property. There's a difference between how you qualify for these loans because it's not like a traditional bank loan where you get put up your credit. They check your credit, they look at your income, your 10-year residency, no gaps, your firstborn, your blood sample. They get all that stuff, and then they say, sure, we'll give you a loan. They're qualifying you as an individual, and they base it on really three criteria: credit, income, assets. Well, with an IRA, you don't have credit and you don't have income, but you've got assets. So the banks that will do these loans typically just want a larger down payment. Okay? They want 30 to 35% down. Most of the banks that will do these IRA loans, they might be picky on the type of investment, meaning, for instance, one of the ones that I'm very familiar with, North American Savings Bank, they're the one that a lot of our clients use, NASB.com is their name. Last time I checked, they were okay doing loans on income producing property, as long as your IRA had 35% down. Income producing property, meaning a rental property that you're going to intend to rent, multifamily, commercial property, but they won't do a loan on land. Because remember, if their only qualifying criteria is the down payment, well, what happens if the value of the land goes down? Well, it's their only safety net there. Now, that doesn't mean that banks won't loan on land. There's just some banks that are specific about the type of asset you have. I do have another client that did get a IRA loan on land that his IRA bought, and he went to his credit union to negotiate that. So basically, long story short, you're not going to go to Wells Fargo or Bank of America or Chase to get one of these loans. You're going to go to banks like North American Savings Bank, First Western Federal, Equity Max out of Miami. So that's actually one that services a lot of our clients here in Florida. Check with each lender, see what qualifying criteria they have. Most likely, they're not qualifying you, though, because you're not the borrower. It's the IRA. So in the qualifying criteria, they just want X amount down in most cases. Hope that answered your question. Charles, if you have a traditional IRA over 5 years old and a Roth IRA that is also over 5 years old, and you can say 50,000 from the traditional to the Roth, when could you access the 50K, and when could you access the earnings without taxes need to be paid? So good question. So let's just wrap it up or kind of encompass everything that we talked about. First of all, there's no 5-year clock on the traditional, so don't even worry about that. If you've got a Roth IRA, remember there's one 5-year clock that has to do with what's in the Roth IRA and what you've contributed to the Roth IRA. But if you decide to convert money over, that's going to start a different 5-year clock, and it's only going to be specific to the amount that you convert. So when you convert, we'll use your example, $50,000. You convert $50,000 from your traditional to your Roth. You're going to get a 1099 for that $50,000. You'll pay the taxes come tax time. So taxes have been taken out of the way. So if you decided to remove that $50,000 as a distribution to you, you wouldn't have to pay taxes on it because you already paid the taxes, assumingly. But if you don't meet the 5-year seasoning, you're going to have to pay a penalty on that distribution. And if you took the earnings out too, you're not going to be able to get away with paying no taxes and penalties if you take it out prior to having the conversion season for 5 years and being above the age of 59 and a half. Okay, so those two criteria, 5 years and 59 and a half. Once you meet those two criteria, every distribution you take out of your Roth IRA is tax-free and penalty-free. So that's how you get the maximum use of a conversion or a Roth IRA to begin with, is 5 years and 59 and a half. Clarification, please. I have a Roth at Morgan Stanley. It has been open for 10 years. If I roll it to NuView and then do a conversion of another 401k into the NuView Roth, will I be subject to seasoning rules, or will everything be seasoned? So if we break that up, if we're talking about your Roth for 10 years, that already has seasoning. Okay, so you don't got to worry about anything there. If you move that to NuView, nothing changes. Okay, we're just going to continue with that same 10-year clock. With your 401k, the first question I would say is, okay, how much of the 401k is pre-tax and how much of it is after tax? Okay, so if you're breaking down that 401k, you're getting separation of service, you're leaving that job. Okay, you're going to roll the Roth money into your existing Roth IRA that has the 10-year clock. But if you decide to convert the pre-tax money over to a Roth IRA, that's going to start a 5-year clock on the pre-tax dollars. Okay. So anytime, whether it's a traditional IRA or a SEP IRA or a 401k, if it's coming from pre-tax and you're moving it to after tax, that has to be done through conversion. And again, a conversion is going to have its own 5-year clock. So you're fine on the Roth portion of it, but the traditional is going to be, you're going to have some seasoning there if you decide to convert it to a Roth. Now, you could keep it as traditional if you want. There's nothing stopping you from having a Roth IRA and a traditional IRA, and actually even partnering those two accounts together to buy property. Again, the analyzation you want to look at is everything that we talked about. What's the investment that I'm going to make? Does it make sense for me to just keep it in my traditional and just partner with my Roth, or does it make sense for me to convert it prior to making the investment? The investment is always the decision, the main decision criteria, I think, because if you can outpace the taxes you pay with the tax-free growth, it's just a life-changing event when you look further down the road, especially as you get deeper into retirement and think about RMBs. And again, if you're buying investments that are income producing, notes are income producing property, multifamily, commercial property, just fee simple real estate, single family residence, all income producing property. If you can structure it right and work and plan ahead, accumulating rental property and owning it in a Roth IRA gives you tax-free income that you get to live on in retirement. You're off the grid. Uncle Sam can't touch you. And if you've got enough in the Roth IRA, you don't have to do any investments personally because you're a taxpayer. So you can really live with and maximize the amount of profit you make by getting Uncle Sam out of the equation earlier rather than later, if your investments justify those types of income in retirement. Now, if you're just buying stocks, this might be irrelevant to you because stocks aren't going to give you monthly income. You just got to buy and hope it goes up. So again, based on the investment, it might make more sense to have the income in a Roth IRA or the income being tax-free in a Roth IRA. It really just depends. So let's see, another question. So if I transfer Roth 401k contributions from this year to a 2010 established Roth IRA, the earnings from the 401k transfer will use the 2010 start date of the Roth IRA. Well, again, remember on earning, anytime we're talking about earnings, let me back up just a little bit. So when we talk about the Roth IRA, okay, Roth IRAs, when you take distributions from a Roth IRA, they come out in a certain order. It's different than a traditional. Traditional, you take money out, you pay taxes, and you pay a penalty if you're under 59.5. It's pretty straightforward. With a Roth IRA, distributions out of a Roth IRA come out in a specific order. The first money you take out of a Roth IRA are your contributions. So any money that you put into a Roth IRA out of your pocket and contribute to it, since those are after-tax contributions, those can come out anytime tax-free and penalty-free. You could put $6,000 in a Roth IRA and take it out the next day, and you don't have to pay any taxes or penalties on it. Because remember, it was after tax to begin with, and they don't penalize you for taking contributions out early. The next set of money that comes, if after you've exhausted the contributions, what you dip, the next bucket of money you dip into is conversions. So on the conversions, remember, when you converted it, you assume that you paid the taxes on the conversion. So it's just all about whether or not you have to pay a penalty to take that money out or not. Then lastly comes the earnings, okay? And the earnings aren't going to be tax-free and penalty-free until you have qualified distributions, meaning you're above the age of 59.5, and you've had it for 5 years, or it's converted for 5 years. So remember, ordering rules with the Roth IRA. Contributions come out first, tax-free, penalty-free, anytime you want to take those out. The next set of money is conversions. You won't have to pay the tax, but you might pay a penalty depending on where you're at. And then the earnings, that becomes tax-free and penalty-free once you have the 5-year seasoning and you're above the age of 59.5. So great questions. If you guys have more questions, what I'd like you guys to do is just shoot an email to IRA specialists at NuViewTrust.com. I'll have Alex type that email into the chat box if you like. That goes to all my IRA specialists here at NuView, and we can answer questions or set you up with a consultation where we can dive into actually your specific scenario, because everybody has different scenarios. And I appreciate all the questions. I can see everybody's got things at different places. That is normal. That's commonplace. Let us kind of have a consultation with you so we can dive into that and give you some more specific answers. So stay up to date with us. We've got a whole month of August planned of more continuing education just like this. I know our next class is going to be buying real estate in an IRA. I'm actually going to dive into not only case studies or examples, but dive into the forms. What paperwork do you need to turn in to take title to an investment or a real estate property in your IRA? So that'll be real helpful to people that are still kind of on the fence and saying, well, I get the concept, but I don't understand the process. So we're going to tackle that in the month of August. We're also going to talk about how to do loans out of an IRA, both from a lender's perspective and a borrower's perspective. Really great class. That's going to be the second week of August. Then we're going to talk about taking small accounts and making them larger. So how do you take HSAs and ESAs and small Roths? What do I do with that? I can't buy real estate. There's actually a lot of real cool, creative real estate strategies, or just strategies in general. We call it how to make big bucks in small accounts. And then the last week of the month, we're going to talk about more creative investment strategies with self-directed IRAs, and we'll talk specifically about debt leveraging, borrowing, having your IRA borrow money, strategies with that, and some other real cool investment strategies. And in those last two classes, I'll just give you kind of a sneak peek. I've got 2 case studies where 2 individual clients on 2 different real estate strategies took $10,000 and turned it into $200,000 completely tax-free in a Roth IRA in 2 years or less. 2 different case studies, 2 different clients, 10,000 to 200,000. So make sure you tune into that. Make sure you follow us on Facebook so you get live notifications of when we go live. Make sure you subscribe to our YouTube channel. Am I saying enough, Maggie, on this stuff? Does that make you happy? Okay, cool. Because Maggie likes from people follow us on social media. There's the classes that I talked about. August 4th, how to buy real estate in an IRA. August 11th, how to be a lender, how to make big bucks in small accounts, and how to use leverage to help grow your self-directed IRA exponentially. Go to our website and you can register for all of those classes. Just go to our resource tab. In our resource tab, you'll see webinars. Just click there and you can register for all those. You also get a copy of the recording when you register. So if you miss it, don't worry, we'll send you a copy of the recording. And if you are interested in opening your own self-directed Roth IRA, self-directed traditional, SEP, simple 401k, HSA, ESA, we've got this promo until the end of the month, which is the end of this week. And we are not charging any application fees for new accounts. So that's a great way to get started where you're not getting feed to death. Just contact again, you can email info@NuViewTrust.com or IRA specialist at NuViewTrust.com and use the promo code FREE21 and we'll waive those account opening fees. But I always suggest talk to one of my IRA specialists to maximize the information and get a free consultation. So thank you guys. Thank you guys for joining us. I'm tuning out. We will see you guys next Wednesday. Have a good rest of the week.